In answering the question, why aren't economists wealthy, successful investors? Or are they? It's important to delve deeply into the factors that differentiate economists from those who excel in investing. On the surface, economists seem well equipped to thrive in financial markets. They possess a deep understanding of how economies function, have an ability to analyze data, and can forecast trends using complex models. Yet, despite these skills, many economists don't achieve the wealth or success that star investors like Warren Buffett or George Soros enjoy. To understand why, we need to explore several underlying reasons and examples that shed light on this paradox. To start, economists rely heavily on theoretical models to understand and predict market behavior. These models are built on assumptions of rationality, market efficiency, and predictable trends. For instance, many economists use the efficient market hypothesis, EMH, which assumes that all available information is already reflected in asset prices, making it impossible to consistently beat the market. According to EMH, trying to find undervalued stocks or predict market movements is futile because the market prices already reflect all known information. While this theory is supported by academic research, it is not always reflected in the practical world of investing. Successful investors like Warren Buffett have made billions by identifying undervalued stocks and capitalizing on market inefficiencies. If Buffett had adhered strictly to the principles of EMH, he might have missed many of the opportunities that led to his immense success. A real-world example of how economists and investors differ can be seen during the 2008 financial crisis. Many economists, relying on models that assumed rational market behavior, failed to predict the housing bubble and subsequent collapse. Conversely, investors like Michael Burry, a former neurologist turned hedge fund manager, recognized the market's irrational behavior and bet against subprime mortgages, earning millions in the process. This shows a stark difference in how economists and investors interpret market data. While economists may have been too tied to their models to see the warning signs, investors like Burry, with a mix of data analysis and intuition, were able to exploit the market's inefficiencies. Economists' reliance on theory also tends to make them risk-averse, which is another reason they might struggle to become successful investors. Economists are trained to minimize risk, analyzing large sets of data to make cautious predictions. Their conservative nature often prevents them from making bold investments, which is critical for high rewards. For example, John Maynard Keynes, one of the most famous economists in history, had a period of substantial success as an investor, but his early career was marked by heavy losses due to over-reliance on theoretical predictions. It wasn't until he adopted a more flexible, risk-tolerant strategy that he started to see considerable gains. This shift in mindset from economic theory to a more hands-on, market-driven approach was crucial to his later investment success. On the other hand, successful investors are comfortable with uncertainty and volatility. They understand that the best opportunities often arise in unpredictable, risky situations. Take Peter Lynch, one of the most successful mutual fund managers in history. Lynch made his fortune by carefully analyzing individual companies rather than relying on macroeconomic trends. He famously said, "Far more money has been lost by investors preparing for corrections, or trying to anticipate corrections, than has been lost in corrections themselves." In other words, Lynch recognized that markets are inherently unpredictable, and trying to predict them, as many economists attempt to do, can lead to missed opportunities. Another key reason economists may not become successful investors is their focus on macroeconomic factors, rather than micro-level details that can drive investment success. Economists are often concerned with broad indicators like GDP growth, unemployment rates, and inflation. While these indicators are crucial for understanding the health of an economy, they do not always provide actionable information for investors who need to focus on specific industries or companies. For instance, an economist might analyze the general state of the economy and recommend a cautious approach to investing. However, an investor might notice that despite economic downturns, certain sectors, like technology or healthcare, are thriving, and there are opportunities to invest in individual companies that are growing despite broader economic challenges. During the COVID-19 pandemic, many economists predicted long-term economic damage and advised caution. However, some investors recognized that companies like Zoom, Amazon, and Peloton were poised for growth as they catered to the new stay-at-home economy. Those who invested in these companies saw substantial gains, while a broader economic analysis might have missed these specific opportunities. In addition, economists' tendency to focus on rational market behavior can limit their ability to account for the psychological and emotional factors that drive markets. Successful investors like George Soros have made fortunes by understanding not just the numbers behind market movements but the human emotions, like fear and greed, that cause market volatility. Soros' theory of reflexivity suggests that markets are influenced by the perceptions of participants, which can drive asset prices to irrational levels, both high and low. By capitalizing on these emotional swings, Soros has been able to achieve significant success. Economists, on the other hand, often overlook these irrational elements of market behavior, focusing instead on models that assume rational decision-making. That said, there are exceptions to the rule. Some economists have transitioned into successful investors by combining their academic expertise with a more practical, flexible approach to markets. Robert Shiller, a Nobel Prize-winning economist, famously predicted the dot-com bubble and the housing market crash. Shiller's success comes from his ability to apply his understanding of market psychology to real-world investing. Similarly, Paul Krugman, another prominent economist, has leveraged his knowledge of economic cycles to make informed investment decisions. However, these individuals have achieved success by going beyond the traditional economist's approach and embracing a more dynamic view of markets. In conclusion, while economists have a strong theoretical foundation in understanding markets, their reliance on models, risk aversion, and focus on macroeconomic trends often prevent them from becoming wealthy or successful investors. Successful investing requires a blend of data analysis, intuition, and a willingness to embrace risk, qualities that many investors possess but are not always cultivated in the field of economics. However, those economists who can bridge the gap between theory and practice, like Robert Shiller or John Maynard Keynes, can indeed find success in investing. Ultimately, it's not just about understanding markets in theory, but also about navigating the complexities of real-world investing. Thank you for watching.